November. Just going to have a recap then of what's come out over the weekend, what we're looking for this week. Definitely from a calendar perspective, this week is a lot more busier than it was last week, and so we'll have a run through of those events forthcoming and some of the key things that we're going to be looking out for. So first off, just having a look at the charts this morning, there's probably one outlier here in terms of market performance from the reopening of trade overnight and so far what's occurred this morning, and that is the value of the British pound. And as you can see here, cable, it's the sterling dollar, having reopened in trade. This is the cable future we're looking at here. Little gap lower at the recommencement of trade Sunday night, and then immediately coming under some pressure, finding a bit of support around the low that was seen towards the end of last week on would have been Friday morning. But then as Europe in the early move stepped into the market, we broke that with a bit more momentum to the downside, and we've just had a little flirt with the 31 handle briefly, which was around the low that you can see that was back on Thursday morning, before we've had just a bit of a bounce here more recently. But sterling under the performance is the main kind of thing of the morning, and just having a look a little bit broader on the technicals first, and then I'll explain fundamentally why the pound has weakened like it has. You can see near term that kind of double bottom developed towards the mid to latter part of last week is the first area of kind of support that we're looking at the moment, in terms of if the market can make a concerted break beneath these levels, and then you would say then opening up a target down around the 130.53 handle, which would be the November 3rd low. Obviously you've got in the interim period the S2 level as well at 30.72, so you could play out that short accordingly should this move and this eventual level be broken with more conviction. Looking on a daily chart, this is obviously one we've had marked up for a while, and looking at the kind of story through year to date of the pound. Now that one, if you go back to the 90 again, that 130.53 level, which was that 3rd of November low, it is significant, because if we look slightly longer dated, it's around this area. So I've got it marked here on a daily continuation around 130.59. You can see here that was also around the beginning of October low, and you can see that was also the corresponding high seen kind of May time and also in the summer, early July. So it's a significant level, and if we were to break through this kind of 130.50 type midpoint of the handle, then obviously it opens up a bit of a push lower psychologically than the 130 handle, and then below there really isn't a great deal of technical significance beyond that point. Now, what's the reason behind the weakness then of the pound? Well, I'm sure you've read the press already, or over the weekend at least, and there's no respite for Theresa May. She continues to remain under pressure. Reports circulated in the Sunday Times that basically she's got now 40 Tory MPs that want her to basically step aside. Now, if you remember the news flow that we had over the couple of last weeks, that number was at about 30, I think, about a month ago. So the number of MPs now that are dissatisfied with her performance in this leadership over Brexit has now increased to 40. And this is very important, because we're getting ever closer to the key number of 47. Once we get to 47 MPs, they can then, if you get to one more, 48, you can push for a vote of no confidence in the Prime Minister, and therefore just basically squeeze her out. Now, the two people at the weekend, again, if you're reading a lot of the national press, it's the old duo of Johnson and Gove. Just when you thought that kind of election pantomime show that happened in the immediate kind of aftermath of Cameron's resignation, then here they are back to the foray again. Johnson and Gove saying that they're dissatisfied in particular about the speed of the EU negotiations that are ongoing. They want the UK to take a firmer stance and so on, not forgetting, you know, Boris was one of those people that put himself on that side of better off outside of the EU. So they're putting an immense amount of pressure on the PM. And certainly, again, the bigger point here is that this is destabilizing from the effect that if Theresa May, and this is a big if, because I still do very much question the fact that do any of these other Tory members really want to take the mantle and really step up to the plate and become the Prime Minister? Probably not, because politically it's a bit of a poison chalice in the sake that I don't really think any of the others can do much of a better job. So whether May stays or goes, the more domestic issues that there are, the more delay there is to the negotiations with Europe, and that's the bottom dollar. And so that's what's the people are getting worried about, and hence the translation into sterling uncertainty from this morning. So one thing to keep in mind here is, I know there's in terms of our internal training course, there's guys obviously have transitioned to the live markets for the first time today. Now, a couple of words of not warning, but let's call it a couple of words of advice. It's your first day trading live for some of you ever. There's no rush. I did see someone jumped into a trade pretty quickly. You know, one thing you've got to understand with things like sterling moves and the way that if there's weekend news, the way the market reacts to this is really you've got to trade at 11 o'clock at night on Sunday. You know, put your kids to sleep early, tell your wife you're going to be up late to bed, and that's when actually you can get the best trades, are at 11 o'clock in the evening on Sunday, because that's when the market reopens electronically, and then that's when the trade can happen. You'll see two distinct phases to the move. That's that move that I've just spoken about, and then you can see here 6 o'clock, that's exactly when Europe and the UK start coming into market and traders trade it. What can be quite misleading is then you guys come in and it's more like 7:30, 8 o'clock, and then you're here and you want to take that short. Now what happens is, if you think about it, the market's already down 100 pips at that point. There's a gap, the move lower overnight, commencement of Asia Pac, commencement of the European session. So actually the trade, this is why this level probably hasn't played out so much, because the market's already factored in a full point repricing so far. So just market timing is key, and certainly although we are looking at shorts around these levels, you've just got to be aware of the positioning and the movement that has occurred from the overnight session. The bigger the move is generally, then at some point it would have factored in this new negative news flow. And so unless you get another clean technical move lower, then the move for the moment might be kind of factored in that respect. So just timings are very key when it comes. In the FX market, as you'll know, FX traders come into the market very early. You're looking around really 6 to half 6, they start trading the actual news flow, just as a future reference. One of the other things that's occurred obviously for the UK, and this is something we're going to look out for later on this week, because we do get UK retail sales. This isn't the major tier 1 release, this is Visa. They run their own the payment company, their own tracking of retail spending in the UK, and British shoppers have reined in their spending by the most in more than 4 years in October, according to the company. Another sign that the squeeze on incomes is hitting the high street, and obviously, as we mentioned a lot last week, coming on the back of kind of a very cautious guidance from the likes of Next, one of the kind of sentiment of the UK high street as far as the UK retailers are concerned, and they were very, very cautious about the Christmas period. This type of data as well forthcoming just kind of adds to that argument of a tough period ahead, particularly under or amid this political uncertainty. One of the things that I was reading at the weekend, and really if we go quickly back to the pound just to have a look, is although the pound's under pressure this morning, if we go back on a daily chart, one thing I would say is that I think I did a poll on Facebook, and I was asking people within our community, so thanks to those that took part, whether you think the government of Britain can secure a transitional deal before year end, because that's been their target. That's when we saw last week the EU said you've got 2 to 3 weeks to submit a revised, basically, divorce fee in order to secure a transitional deal by the middle of December, which is a key EU summit. Now it's looking, given the domestic things that have occurred over the weekend, that that's becoming increasingly unlikely. And that's as per what you guys have said you expect, that transitional deal is unlikely to happen before year end. I probably agree with that assumption. The thing is here, there's two ways of playing this Brexit story. The longer there is no transitional deal, and let's say this goes into the end of year, I think that that's likely to be the case. Then if you start to extrapolate that with further pressure on the UK consumer, loss of confidence, lack of spending over the Christmas season, I do definitely think that in that setup then we can see a decent breach of 130 and then really pushing back down to 128. I don't really discount that at all. The one caveat though that you definitely need to be aware of is that if Theresa May somehow can muster up support and get the EU on side and secure a transitional deal, I would expect the pound to rally once that event does occur. Now, the way to play this is really in the near term, my bias would probably be more negative, but any signs that there's going to be a revised tabled number, let's say probably the next point of interest will be 30 billion. I still don't think that Europe would accept that. I think the number is going to be more like 40 billion. But once we get to that latter point, I would expect the pound to rally fairly considerably. I've seen quite a few different banks looking at maybe a retest up at 136, 137, which, as you can see here, was the peak that we were at during the Florence speech that May gave. And we know that since then it's weakened. So just something to be aware of between the intraday and then the more kind of medium long-term play for sterling. Okay, having a look elsewhere, let's have a look at crude oil. A couple of things to have a look at. Now, putting WTI crude on a weekly chart, obviously the last couple of weeks have been just pretty phenomenal for oil, just continuing to ramp up prices to, certainly we broke the year-to-date highs. And now we're looking at levels really, although we've steadied here, we're pretty flat this morning. $60 certainly cannot be discounted over the coming week or weeks ahead. And then you'd be targeting up and around, this is again a daily continuation chart. You've got the 2015 high that was printed at the beginning of May, 62.58. So having a look, a couple of comments from over the weekend. We've got here the OPEC head says oil cuts only viable option to stabilize the market. So continued rhetoric. We've had obviously the Saudi purge, which has kind of lifted, if you like, tensions within the Middle East, which is something definitely which plays to the hands of the bulls, particularly given the connotations that this could have with the breakdown between Saudi and Iran in particular. But you've had the Saudi government backing of an extension of OPEC cuts, which, don't forget, Saudi shoulder the burden of. And so that's been one of the key reasons as well for the lift we've had of late. And now you're getting the likes of Barkindo, who's just basically saying that the oil market is rebalancing at a quicker pace and production cuts are the, quote, only viable option to restore market stability. So if you remember, when we talk about the OPEC meeting, which actually happens in about 15 days time or so, or 17 days to be precise, we always know what they're going to do well in advance of the actual meeting. So actually what you might get, we've had this on previous occasions, is we're bid up into the market up to the meeting, they're all given the intention of what it is they're going to do, and then OPEC actually then extend the OPEC cut deal to the end of the year of 2018, and then actually we get a bit of profit taking. So it would not surprise me at all if that's a similar thing that occurs. So between now and then, potentially still some further upside to be seen before that kind of buy the rumour and then selling the fact when it comes end of the month when they have that OPEC official meeting. One of the other things we had at the weekend was this. So I know Darren was talking about this in the live room. US drillers, this is the Baker Hughes rig count number, which happens at the end of every week on a Friday at 6 PM London time. So US drillers added 9 oil rigs in the week to November 10th. Now that might not sound like a lot, but actually that number has been decreasing, as you can see here on the graphic on the bottom side. More often or not, in the last few months, there's been subtractions of operational US rigs, not additions, but this was the first jump and the biggest increase of 9 rigs that we've had basically since June. So if you can see here, dating all the way back to when we had a number of about 11 that were added. Now this is quite interesting because obviously this bucks the trend. You can see here really, if you look at the blue line, the number of rigs that we've had in the US, we peaked in around midsummer, right in the middle of August, and since then, after we got to about, I think it was 768, we've been declining ever since, before now just taking a bit of a bounce. Did read quite an interesting piece here from ING, and they were highlighting a couple of things which might be worth just quickly covering. They said daily rig rates in the Permian, and so the Permian region is the highest amount of productivity of shale amongst all the different regions that produce in North America. They say the Permian region has increased by circa 10% year on year. But they do note a couple of things here. Raw material costs have also edged higher. There are also signs of tightness in completion equipment and teams. They also said another factor to focus on when looking at US production is the increase in decline rates in shale oil. These have steadily accelerated over time, and higher well concentration is one of the reasons blamed for this. More wells drilled within close proximity risks reducing well pressure, and as a result hitting recovery rates. So if you think about it, you've got more sites that have been operating when they're drilling. The lateral length of the kind of process of fracking, if you like, is getting, so you're getting more efficiency out of each location, but that's taking up more area space, if you like, and so the sites are getting more saturated, so there's lesser productivity coming out overall as a net result. Not only that is completion equipment and teams. Obviously, if you keep adding more and more and more rigs, is there enough qualified staff to do that, to continue at that pace? Because obviously then if you're having to compete over a smaller workforce of specialized people within that industry, you have to pay them more. So therefore the break even then starts to rise. And then you think about the raw material costs that get more expensive, as we have seen globally, economic growth, therefore greater demand, raw material prices are edging higher. That also then needs to be net into effect, go into the break even price edging up again. So it's not all a case of that the US can just continue to pump and pump and pump. There is a net effect of global economic improvements on the price of material costs. There's the lack of continued employees available within that sector to hire, also as well, in addition to the equipment that's available for the process, and then also the kind of saturatedness of the environment of which they're actually drilling. Given the plethora of sites now in operation. So just some quite interesting things there for more longer term to be aware of. A couple of other things just to finish off that we've had. Fed's Harker, so Fed officials, that's going to be a real prevalent theme of speakers throughout this week. You've got Federal Reserve officials said on Monday expects to back an interest rate hike next month despite caution over low inflation. US central bank policy needs to be positioned to deal with future economic shocks. So odds on the Fed, despite last week we had a bit of a, well, it was initiated by a big drop in the Nikkei Thursday going to, I think it was Wednesday going to Thursday morning. That initiated then a bit of a snowball effect of negative sentiment. But overall, net, this is almost a net essential thing that we need. Whenever we've seen the market push to record highs in global equities, it takes a mild type correction, and when I say mild I mean relatively very small, before then the market can lift to the upside again. And a couple of things obviously we need to monitor on this, and the US tax issue is definitely one of those. That continues to kind of go along in the background, but overall Deutsche Bank this morning, their chief US economist, noting that believes there is a decent chance that some version of the tax reform can be achieved, but this is likely to be a Q1 event with potential stumbling blocks along the way. And obviously one of the bigger stumbling blocks coming up in pretty much exactly a month's time is the US is due to hit their debt ceiling again. Now Trump obviously has been pushing for tax reforms to get pushed through the chambers of Congress as soon as possible. But I think just given what we had last week, that was another real reason for that equity sell-off in the second half of last week. Disappointment that actually this isn't going to be a smooth, clean process, and we're going to go through multiple revisions, I'm sure, between the House and the Senate's bills. The longer that takes, the more net negative that starts to develop, and again this whole Trump implementation risk kind of re-emerges in that sense. One other thing just quickly to have a look at before we get on to the calendar, because there's a couple of things I just want to quickly run through, is Bitcoin. Obviously a lot of people talking about this. Just given the nature of the job that I do, I don't think I can go a weekend without either a friend or family member talking to me about Bitcoin. And as much as it drives me absolutely mental, you know, I've got complete faith that Bitcoin, but more importantly the blockchain technology, is definitely 100% going to be the future, and it's going to be a real main staple of how payment solutions and so on will be done in the future. I have no doubt of that. The thing that obviously that worries me is when we start to see moves like we have done. I'm sure you've read this morning, Bitcoin plunging 29% after hitting its record high. So, you know, I just want to say that I know this is not something we comment on a lot, and that we're actively trading here at Amplify, but you know, just given the press, the amount of marketing and advertising that I see for this pushing out to the broader public, if you are going to trade something like Bitcoin or crypto, please be careful. You know, you can have phenomenal returns, but it comes with a high degree of risk. So before you commit any real capital in size to this type of trading, I just want you guys to make sure that you're really aware of the risks associated with that level of volatility. That's all I'll say with that at the moment. You know, this is one of the things here, though, that quite interesting from just a behavioral point of view. You can see here, looking at this chart, we rally up to, and this is the way that Bitcoin. Yes, there are fundamental factors that do drive it, but it's very much a behavioral market in this sense, because it's still a fairly new market. It's not matured yet, and so it responds quite well as well to technicals. And if you look here, we've got to 3,000, so big levels or handles have been very key in terms of reading the price movement, and we hit that level, then decline 38%. You can see you breach. Very quick run to 4,000, hit 5,000, profit taking again. Gets down to 3,000, everyone joins the trend, back up, breaches the handles. You can see 6,000, takes a breather, breaks 7,000, breather, 8,000, and then you get an aggressive pullback again. So just interesting about the way in which the handles have been working as real targets when people are investing in this type of product. And then also what is looking, if you look at the trajectory of the fall that's happening now, it's becoming more and more steeper, which obviously makes sense given the price is much more multiple times higher than it was when we were trading back here. But just to be aware of the risks associated with that, that's all. Alright, quick look at the daily calendar for today. It's very quiet. This is a very busy week, don't get me wrong, but today is particularly quiet from a scheduled basis. But do be aware the Senate Finance Committee will commence markups of its draft tax bill, while the House's tax bill is expected to go to the chamber vote not until later this week on Thursday and Friday. So today's pretty quiet overall, but look at this and look at Tuesday, for example. Tuesday looks a lot more interesting, because you have, just to recap a few of the highlights, the final revisions to October CPI reports in Germany and the UK. In terms of speakers, you get ECB's Draghi, Fed's Yellen, Bank of England's Carney, BOJ's Kuroda. They're all scheduled to participate in a panel, or a policy panel, hosted by the ECB. If you remember, the last time that these four heads of central banks spoke was back in central Portugal, and it caused a huge move in yields and consequently the euro currency and so on and so forth across other assets. This was, I guess, probably about 4 months ago or so when that central speech happened. And so that was because at that time it almost felt like ex the BOJ, a coordinated turn to becoming more hawkish in terms of central bank forecasting or guidance going forward. So it'd be very interesting to see what they have to say. So they're all speaking on Tuesday. Also on Tuesday, President Trump is due to attend the East Asia Summit, and UK PM Theresa May's Brexit legislation subject of 2 days of examination in the House of Commons. So if you were looking to Theresa May's response, let's say, to what's happened and occurred at the weekend, well, she's got to give a Brexit legislation update of 2 days of examination in the House of Commons over Tuesday and Wednesday. So if there is going to be more negative sentiment developing there, and to see how she stands up to this conservative pressure that seems to be mounting, we're going to find out more details then. Wednesday, so just scanning down here. Wednesday, the key things: October CPI report in France, September-October employment stats in the UK, and obviously the wage data will be very key to look out for there. But this is actually one of the bigger data points of the week. The US, we get the October CPI print, as well as retail sales, Empire Manufacturing, September business inventories. And obviously it's CPI that's critical to the prospects of how the Fed and how confident they can be. Not so much whether they're going to deliver a December hike, because the median consensus is for a 0.1 uptick and a 0.2 uptick on the core readings for inflation, so it is going up. But it's going to be important for how does the market then reassess the leadership under Powell when he takes the fold in February of 2018. Also, Wednesday, you have NAFTA negotiators from the US, Canada and Mexico scheduled to meet for round 5 of their discussions. So something else to be aware of. Finally, looking at Thursday and Friday. Thursday, you've got UK retail sales data, so as we said earlier, it's going to be important given some of the pre-indicators have been quite weak. Bank of England's Carney, Broadband, Haldane are all speaking at a public session as well on that same day. And then Friday, finally, things get pretty quiet. So schedule-wise, it's a real hump in the middle of the week between Wednesday and Thursday being particularly busy. But Friday, you've got ECB's Draghi due to give a keynote address in the early morning in Frankfurt, and ECB's Hubert Hawk Weidmann also due to be speaking. So quite a few things there to look out for the week ahead. All right, just to finish off, a quick look at the pound. Just having a quick retest down at its lows again here. So 130.72, as I said, you've got that S2 level below here. Then 130.53 being the overall target on that short if you're looking, or if you're in that trade and scaling out of it at the moment. Okay guys, that's it. Any questions, let me know in the chat room. Otherwise, have a good day and have a good week. Thank you very much.